Despite a decent start for earnings season, Wall Street experts are increasingly warning that corporate profits are likely to take a hit as inflation remains a headwind to economic growth and pricing pressures take a bigger toll on consumers. Margin expectations look overly optimistic for the ball. The Russia-Ukraine conflict has led to a spike in energy and food costs, which serve as nothing more than a tax on a consumer that is already struggling with high inflation. With inflation rising 8.5% in March compared to a year ago, the biggest increase since 1981, investors also worry that the Amid growing recession calls on Wall Street, the Fed's policy tightening raises the odds of recession to 15% in the next year and 35% within the next 2 years, according to Goldman Sachs chief economist Jan Hatzius. In the post-World War II era, 11 out of 14 monetary policy tightening cycles have been followed by a recession within the next 2 years, he warned in a recent note. Taken at face value, these historical patterns suggest the Fed faces a narrow path to a soft, economic, landing. Earlier this month, Deutsche Bank became the first major bank to predict a looming recession, and since then a rising number of firms have joined the chorus and issued similar warnings. Within the S&P 500, 356 companies cited the term inflation during their earnings calls last quarter, the highest number since at least 2010, according to FactSet data. If the current trend continues, that number could be even higher this quarter. Major bank is first to forecast a recession, more could follow. Forbes JPMorgan boosts credit reserves as profits tank. Dimon warns about significant challenges ahead. Forbes Federal Reserve hints at bigger rate hikes ahead, outlines plan to shrink balance sheet. Forbes